where the funds are invested with an average maturity of 1 to 3 years, then long term, and then very ultra short term. So these things we looked at it, and we also said that no, very conservative investors probably would go for debt fund, and probably which can give a return which is slightly more than the fixed deposits. Then the second category that we gave was the exchange traded fund, and in the exchange traded fund, we discussed how the exchange traded fund can be invested. That is, it is like a share, and it is available in your trading platform itself. So you can click and invest in that. And we have seen that some of the ETFs which are listed there, or the Nifty Bs. Then we have ICICI Nifty. So these are, and also there are some other ETFs also available. So you should look at the overall liquidity of each of these ETFs, and invest in ICICI or this one. That is the other funds which are there. Apart from that, there are also mutual funds which are invest purely in ETFs. So besides exchange traded fund, in the you have got also index funds which are available in mutual fund platforms, and there we saw the results, the return or the performances, whatever you may call. And last time we saw that the performance in the 5-year horizon was something like 17-18%, and in the case of 3 years it was 13 to 15% or so. So I said keep all these things in mind, so that we will compare with other type of equity funds which are there. So the other type of equity funds which are there, or the funds which are there. We have got the equity funds. In equity funds, we have got large cap. Then you have got multi-cap, then mid-cap. So these are different types of funds which are there. Then there are also thematic funds. So these are some examples of this. So you got large cap, multi-cap, mid-cap, thematic, all these type of, and then a lot of other things. There's ENSS scheme for tax benefits, then opportunities fund you got, then you got the dividend fund. All this thing can come in the thematic thing. So dividend fund. So then arbitrage funds. So many other different types of funds are there. Now, if you look at the mutual fund, generally they would try to beat the index return. Now, in those cases, normally the risk-free, that is the next level, that is from the index fund, the next level of risk that normally is taken. Exchange traded index fund is least risky amongst the equity funds. Then one grade above that will come either the large cap or the multi-cap, because these normally represents mostly the shares which are there in the large, that is within the Nifty 50, let us say. Only thing, the composition can be different. Like for example, they may not have the entire 50, they may have something like 10, 20, 30 stocks out of that 50 which is performing well. That the ratio which they allocate can be different depending on the flavor. Right now, if you see metal prices are rising, so probably the investment, they could have just rolled over the investment more into metal stocks like Hindalco, Tata Steel and all. And at some stage back, it could have been a little more with IT stocks. So before that, it could be more in Reliance, some FMCG. So it all depends on how they rotate the stock. So that is where they show the dexterity of the skill. So the large cap and multi-cap funds are generally supposed to beat the index. Not necessarily that everybody will beat, because if the judgment goes wrong, probably they'll also suffer. Because if they are loaded themselves with more of PSU banking stocks in the last couple of years, probably the return would have been average to poor. But if they had loaded themselves with IT stocks, with Reliance, Asian Paints, like that type of stocks, probably the return would have been much higher. So the large cap and multi-cap trying to generally look towards trying to beat the index in order to give a return which is slightly better than the index, at least by 3 to 4%. Okay. So let us look at the large cap and multi-cap cap fund performance and compare it with the ETF. We will also look at the Midcap. Then we will also look at, time permitting, we will also look at the thematic dividend opportunities fund and all. So let's look at the fund performances in the case of large cap, multi-cap and mid-cap. Now, for which, you need a screener, and the best is, you go to Moneycontrol.com, and Moneycontrol.com or any mutual fund, performance tracker. Moneycontrol is one good site where probably you can get a good overview of various types of funds and the return and the history and the composition and all. So let us look, go to the moneycontrol.com. Okay. So yeah. Okay, I think with all, I think there's some problem in the screen. Okay, the moneycontrol.com. Mutual fund. We'll put no money control mutual fund. Let's say screener. Let's say. Now we'll look at the SIP, this mutual fund screener. This is of course having problem as well. This is okay. Good. Now, okay. So now look. Let us look at the. Okay, I'll keep it here like this. So yeah, this is the these are different types of funds which are there. So now we will look at the performance tracker. We will go to the performance tracker. Okay, and there let us say we have got a multi-cap, large cap fund and all. Now what is listed here is a large cap. Since it is in white background, so I will try to read it out for you. So if you look at the returns, that, for example, Kotak Blue Chip. Okay, now in this, let us say rank within category. So we will first look at the which are doing well. Okay, so we will look at the first one or two over a period of 1 year, 2 years, 3 years. So very okay. Now, okay, let us look at Axis Blue Chip Fund. Now, if you look at the funds which are here, the Kotak Blue Chip and Axis Blue Chip Fund, over a period of say 1 year, maybe the Axis didn't has not done that well. But Kotak Blue Chip Fund has been generally maintaining a rank of 5 out of 30, 5 out of 30, 5 out of 30, and over a period of 5 years, it is 10 out of this one. Blue Chip in the last 1 year has not done that well comparatively. It has been generally a poor performance in the last 1 year. But over a period of 2 years, 3 years, 5 years and all, they have done well. So let us look at the return which these stocks have given Axis and Kotak Blue Chip Fund. What is the return they have given? Investment returns. Now, historic returns. Kotak Blue Chip Fund, if you look at it, it's given 1 year is 11.62, 2 years is 17.75, 3 years is 9.83, and 5 years is 14.22%. So fairly not a great return. Axis Blue Chip, now Axis Blue Chip Fund, over a period of 1 year has given 18.18, okay, 2 years 22.3, 3 years is 17.32 and 5 years 18.22. So generally Axis Blue Chip Fund seems to have done much better than most of the other things, or probably it has done in line with probably one or two of the other funds. But generally if you look at it, I think these 2-3 stocks, Canara Robeco Blue Chip Fund, that has also done extremely well. It has gone 23, 21, 13, 15 other percentage. So over a period of 1 year to 5 years return, generally Axis Blue Chip has done well, 18, 22, 20, 17, 18. This is what we looked at the ETF. That is, in ETF funds also, in the case of 5 years, we are getting something like 18 to 19%. Okay, and 3 years we were getting 13, 14%, and 2 years was also something. So mostly to try to beat the ETF is not that easy. It's not that easy. So even if we look at the other, now let us say we go even to the same thing of thematic funds, which is where the ETF may be there. Let us say. Exchange traded fund. So we'll look at solution oriented. Others will put, let us say, index funds. So index funds, generally most of the index funds will be having the same thing. Let us say Kotak Sensex fund. So here if you look at it, 2 years we saw Axis Blue Chip doing 20 to 23. So here it was 21%. 1 year exchange traded fund has done much better. 5 years Axis Blue Chip has done 18% or 19%. This is 17.63. 3 years 15. So very clear that to beat ETF is not that easy. Beating ETF itself is not that easy. So that's why I'm saying that it is much safer to invest in ETF compared to other type of funds. But the nearest that you will get, if you want to get a return of 1 or 2% more, it could be the large cap fund or the multi-cap funds. So large cap funds have generally given a good return over a period of 1, 2, 3 and 5 years, which is all in the range of 15 to 17 to 20%. So high time the market did very well, and during this time the ETF, to the extent the ETF did well, large cap funds also have done well, but something very similar in line. So let us look at, if you still want to look at what are the stocks that may be there in this. Let us say in Kotak fund and all, it is Sensex fund, means it will be a Sensex stocks. If it is ETF stock, it will be only those which are Nifty stocks, means it will be only Nifty. So depending on how they, for example, Nippon India ETF Nifty base means it will have only the Nifty 50 stocks. But in the case of large cap funds and all, now if you look at the large cap funds and look at any one of the fund, Axis Blue Chip, let us say, we'll go to Axis Blue Chip. Now in the same Axis Blue Chip, we will look at the portfolios. What is the portfolio? If you look at it, you will get some idea. There is no HDFC Bank 9%, Infosys 9%, Bajaj Finance 8%, Tata Consultancy 6%, Kotak Mahindra. So mostly they also have got the same type of stocks which are there, generally speaking, in the ETF. Only thing is the percentage of composition is slightly different compared to the Nifty. So their return is something which is almost mirroring the return of the index. So here you get a detailed amount of the total amount of investment which they have got, the percentage of equity holding they have got, all those things are listed there. So now if you look at the same thing of SIP returns, now you have to calculate. Another thing that we have said is, if you do it, the performances which I am telling you about 1, 2, 3, 5 years, was that exactly if I invested 3 years back, what is the return? If I have invested exactly 5 years back, what is the return? Now, here in this case, what we are looking at is that we are looking at the not only the absolute return, but also SIP return, in the sense this, that you let us say you have done a methodical investment. So, suppose if your period invested for is 1 year, and if you have invested for 2 years, what is the return? That is, every month you have invested for a period of 2 years, what is the return that you have got? Every month if you have invested for 3 years, what is the return right now that you get for the total return? You just look at the performance. In fact, the 1 year performance, if you have done every month, you would have got something like 58%. You would have got something like a 58% return. That is because this year during the pandemic time it fell. Now last year if they have invested, probably they would have invested in January or February, and so the return would be still a little poor, right? But if you have invested only in through an SIP return, then every month you would have averaged out to get a return which is 58%. Next year, if it comes to April or May, this will show you even the SIP will, instead of SIP, one-time investment will show a huge return, because it will show as if you invested only in March or April. But it's very difficult to predict when the market will fall to what extent. So at any point of time, it is better that you keep investing some amount of quantity every month end and also on every correction basis also. Now, if that be the case, then let us say at the end of 1 year, the return that is 58%. 58% if you have done a methodical investment. That is every month in the last 1 year. Suppose if you have invested every month in 2 years, it is 28%. 3 years is 22% and 5 years is 18.61%. So what does it show? This 3 years return of 22% on an SIP scheme is much higher than the return that the same fund over a period of 3 years. Suppose if you invested at the end of in one parcel in 3 years, then probably the return would have been only something like 15-16%. But an SIP scheme over a period of 3 years would have given you something like 22%. And you look at any period of 5 years, 10 years, so the correction enables you to get a very high return. So if you do this is a clear thing which shows that any systematic investment plan gives you a decent return which is 18 to 20%. So what you need to do is it is not a rocket science. Basically what you have to do is you have to allocate some portion of the money which you can afford and put it in an SIP. So every month, probably a particular date you choose, and in that particular date if you put it, let us say month end, month beginning, whatever it is. So let us say you start somewhere in February. Now February, what is the last day? So this weekend. So you invest. Okay, some amount you keep investing. Now you just look at the return that probably you will get over a period of let us say you start to invest 10,000 rupees. Okay, so you build up that particular amount of 10,000 rupees every month, and let us say at the end of 1,20,000. So you would have got 1,20,000 if you got, then return would have been, absolute return would have been 29.38%. Okay, for in the case of last 1 year, if you done 6 months, because average would have been there, so you would have got, and if you got it in the period of 3 years, it would have been 38. So 3 years means you would have invested something like 3,60,000. So 3,60,000 into 1.38 is what you would have probably got right now. And that because you didn't invest in one period of time, it was an average, so you would have got a good return which is around 22%. So suggestion is that you keep, let us say whether it's 1,000 rupees or 2,000 or 5,000 or 10,000, just choose either ETF or large cap fund and keep investing some amount of money every month, and over a period of 2-3 years, just see the return will be good. Okay, so now this is as far as SIP returns in this scheme is concerned. Now even if you look at the SIP returns, even in the case of exchange traded fund, we'll go back and see. Okay. Others will put, and index funds. Okay, Nippon India Nifty Bs. Let us see the SIP in index fund. See the return you got, it is no less than the large cap funds in a systematic investment plan. In fact, the 1 year and 2 years has done much better. 3 years scheme, it has done 22%, which is what we saw. And maybe over a period of 5 years, it's 17.02 and 13.85. This was something like 15% there, and this was something like higher. So anyway, you're getting a return even in ETF, which is very closely aligned with the large cap funds. So you don't need to even take a strain of looking at which large cap funds is doing well. Even if you invest in ETF, it is okay. But if you get probably invest in large cap funds, probably the return can be slightly higher. Okay. So now we look at, unfortunately, we don't have much of the other type of funds which are there, because there is if you look at the IT funds and all, not many IT funds are there even now. Okay. Because most of the IT funds have been only floated right now. Most of the other was just index funds, and probably index funds in the. So we don't have that for immediate comparison. So we'll come to that later on. So we just saw the large cap funds. So now look at the multi cap funds in this. So multi-cap funds, and we'll also look at the rank within. which one is doing well. We'll look at that. Most of the multi-cap funds don't have anything which is beyond 2 years. I think we have no information beyond 3 years. I think most of them are only or less than 3 years. I think some are there. So let's look at this particular fund. This is ICICI Prudential multi-cap fund. What is the return which they are given? So what is the return here? We will see annualized return. Okay, annualized return over a period of 3 years is only 10%, which is much lower than what probably we have seen even in ETF. And 5 years is 14.98%, which is much lower. And so even 10 years is at 12.88%. There the SIP return would have given us more. So the multi-cap fund, in the case of one mutual fund which took ICICI, has not done that well. And even in a 10-year return, probably it is just around the ETF and not much. Even in a 5-year, it has fallen below the ETF, and definitely over a period of 3 years, not much of a return. Maybe in 1 year and 2 years, they might have done well. So very clearly that the margin of performance compared to the ETF, it's really very, very negligible. I think the more or less you get something very closer to the ETF. So that means you can easily buy the ETFs and sell the ETFs in the platform itself. So you can just try to average it out by buying every month. You systematically do an investment in your screen itself. You buy by the end of this month you buy 10,000 rupees worth. Next month you buy 10,000 rupees. So every month you keep buying that approximately 10,000, 10,000, 10,000 you put. Probably you see a good result over a period of time. So this is as far as the large cap and other funds. But other funds, if you see, let's say go to the mid cap funds. Large and mid cap fund, will look at the returns. We will try to choose any one of the funds. Okay, so this Tata large cap and mid cap fund, and then Edelweiss large and mid cap fund regular plan. So large and mid cap fund, let's say what the performance is. Edelweiss large and mid cap fund. Okay. So over a period of 1 year, 24%, 2 year, 22.7, 3 years, 12.76, 5 years, 16.48, 10 years, 12.9%. So absolutely the large and mid cap fund has performed poorly when compared to ETFs. So that's why I'm trying to establish that if there is margin of error in the case of large and mid cap fund, that's because the mid cap fund would not have done that well. So a large cap fund probably, like if you have picked up good funds like Axis Blue Chip, maybe it might have beaten the ETF a little bit. So ETF, if you do even in SIP scheme, it is much better. That is what we are trying to establish. The outperformance that you get from other funds is going to be marginal. It's going to be marginal. So you can invest in large cap funds, probably pick up the right type of funds by going through the screener of the rank within the category of different years, by going through the Moneycontrol.com and identifying that. But at any point of time, if you look at it, the SIPs, even in this scheme, let us say the SIPs would have done much better than one-time investment. So if you look at a 10-year performance, even this is only 12.9, but here it's 14.83, right? Here it's 5 years return is around 16.48. Here it is 17.14. So in the 3 years it's 23.11. Okay, so 3 years is only 12.76 if you look at it. So in a 2 years, it is 2 years and 1 year and all is much better. So even when a market comes down, particularly, so that means whenever the market has risen very significantly, then in that case you should always try to ensure that you go for the SIP. Now that at that point of time, what you do is if you have already got invested, then let us say you've done an SIP over a period of 3 years or so. So at the end of that particular period, let us say you have made some money, chop it off, take the profits. Okay. So if the 1 lakh has become 1,50,000 over a period of 3 years, so what you do is you take the return, 50,000 rupees, you take the profit. Okay. or you prune down, sell off 40% or 50%, keep that money and do the SIP. So that the falls can be averaged out, and there the return can be much higher. So what you should do is, whenever you got a good return, take the profit and then keep it with you and start investing the profit in an SIP basis, which will give you much better return. So this is as far as the large and mid cap fund is concerned, and we will just look at the mid cap fund itself, how mid cap fund has performed. In the mid-cap fund, let's look at this particular one. Invesco has done slightly better, and more so PGIR mid-cap funds have done slightly better. So, or Access mid-cap fund. So, Access mid-cap fund, let's see what the Access mid-cap fund is and what the returns are. So, mid-cap funds annualized return in the case of Access seems to be okay, good. 5 years it has given 19.73. Something very similar to our this one ETFs, or slightly better than the ETF by 1 or 2%. 3 years it has given a return of 18.16%. 2 years and 1 year, okay, it has done decently well. And let's look at the since inception has done 18.28%. And on an SIP scheme, over a period of 10 years it has done well. In a period of 5 years, I think probably and 3 years. Probably even in 2 years and 1 year, I think the SIP in a mid-cap fund has slightly done better than the SIP in the case of ETF. So probably the Access mid-cap fund. And so let's look at what are the detailed, what is the portfolio of the fund. So here, if you look at it, it's invested in mid-cap funds like Cholamandalam, Voltas, Pidilite Industries, so City Union Bank. HDFC Bank also is there. I don't know because it's mid-cap funds, but they've put some money there in there also. So Bajaj Finance, Endurance Technology, Color. So all these things are good, great companies now upcoming. So probably 1 or 2 of them have lifted it considerably, like Bajaj Finance. Probably and as a percentage of holding is around 3.02%, which might have done much better. So they have got the NBFCs which have done well in these particular cases. So a systematic investment plan in Access mid-cap fund also. So Access large cap fund also has done well. Access mid-cap fund also has done well. So I think probably you can look at Access bank in Access investment both in this one, and probably you can go for SIP scheme there also. But anyway, the return that still you're going to get when compared to the ETF slightly is marginally better. Now, if you look at the return that you're getting here, 5 years since inception, 10 years. Of course, in 10 years there you got 13.5%. You're getting 19.5% here. In 5 years you're getting 20.45. There we saw I think 16-17%. So 3-4% you're getting. 3 years it is 25.85% per year, which is also a very good return over a period of 3 years. You're getting 25.85 compared to the normal ETFs where probably 3 years is 25.85 years. So we'll just again go back to make an thing that is this mid cap. Just keep in mind that 3 years is 25, 5 years is 20, and 10 years is also approximately the same. So 25, 20, and 19. So we'll just revisit the so Nippon India ETF Nifty IT is there, so we will just look at that also. But we'll just look at the Nifty Bs. I think it was there. Now, index of funds. So it doesn't matter which one it is. So ETF Sensex next 50. Nifty 50, India Bulls ETF 50, I think not getting, we'll put Nifty Bs. So here, see that 3 years was 25. This is 22. So there it was 20 for a period of 5 years. It is 17%, and 10 years there was 16, 17. So performance-wise, 2 to 3% extra you have got there. So it has been able to beat the ETF a little marginally. Okay, 2-3% extra. Access Blue Midcap Fund has done. So that's what I'm saying, that no, the ETFs itself, the index ETF itself is a very, very decent return that it gives for a period of time. So here over a period of 5 years, you have got 17% by investing every month. This also is a very decent return of 14%, 13.85 to 14% return. There you would have got a return which is 16 to 17%, so 2 to 3% extra you would have got in that particular mid-cap fund. So let's look at the same thing. We just went back to go back to the so here Nippon India ETF Nifty IT. So let's see how many years it has been there. It's just invest in IT stocks, and we don't have much of, see, the question is, I think it's all new. So we've got only 3 months return, 6 months return, year to date return, and also we don't have much of a analysis return here. And so it was installed only in 30th June 2020. So not even 1 year has gone. So the return that we see for that is 74%. So not even 1 year has gone. So we don't have much of a analysis, detailed analysis, but all are good, great stocks, and so the return will be good over a period of time. So with that, I think the comparison ends, because Nifty return that we look at, as Nifty IT return generally gives a slightly higher return compared to the Nifty. That is, the performance of Nifty IT is generally better than Nifty. So an SIP also should do well. So you can also go for an SIP as far as the Nifty IT, or now we have got two those ones. The ICICI Tech is there, which is also predominantly IT, Nifty IT replicates a Nifty IT. Similarly, Nippon ETF IT is there, so which also replicates the IT. So you can get the investment in the index fund. You can do on the Nifty base or ICICI Nifty, which are all based on the Nifty stocks. But if you only want to go for IT stocks, then you've got ICICI Tech and you've got Nippon IT. So you can one of these two also you can go and do a systematic investment in those index funds also is concerned. So what we have established is that whether you have to look at in mid-cap means which is the mutual fund which is doing well. Probably we identified Access Mid-Cap is doing well. Large cap fund Access is doing well. And when you compare the ETF, it is 2 to 3% higher generally you get. SIP returns are much better compared to one-time investment. And these are broad areas, and Nifty IT probably can give a higher return than Nifty, so your return can be much higher. So in the index itself, you can go for a Nifty IT stock, Nifty IT performance. So these are the broad conclusions that we have got. Now let us look at, there are overseas funds also. So let us look at how the overseas funds have done well. Now, because that is also one thing which you can always look at it. So in equity, probably we can look at sectoral thematic thing. So there we can look at so we let's look at ICICI Prudential MNC. So you got overseas fund here, Nippon India Japan Equity Fund, Nippon India US Equity Opportunities Fund. Okay, ICICI Prudential US Blue Chip Fund. Let's look at this. This is ICICI Prudential US Blue Chip Fund. That is where it invests in US blue chip companies. Let us look at that particular return, how it has given over a period of time, and compare it with the own Nifty and other things. So over a period of 1 year, over a period of 3 years, let us say the return is 19.13%. Over a period of 5 years, it has returned 17.27%. Returns which are something similar to our own returns, nothing extraordinary compared to our own returns of 3 years and 5 years. But generally speaking, they have also done well. So, and since inception, it has given 17.3% compared to a Nifty ETF, which could have been around 14% over a period of 10 years. So that is mainly coming, that extra return that is coming probably is coming out of the rupee depreciation also. So if you look at the SIP returns, there also 3 years is 22.202%, that's what we saw, and 5 years we saw the return which is around 19.18%. So something very, very similar to what the returns that we get. So I think compared to ICICI Blue Chip Fund, okay, it is also giving a very good return. You can keep in mind that ICICI Prudential US Blue Chip Fund has also done well. Now there is a Franklin Templeton is also there. So we look at the Motilal Oswal N100 fund is there. So we have to search for it. See, Franklin India Technology Fund is there. So we'll just look at the this. Not getting Nasdaq fund. Not getting any. Probably it's in the index or so. So we will look at the Franklin Templeton US Franklin. Not able to get this. Okay, Templeton. Let's Templeton. Not getting that. So we'll leave it for the time being. We're not getting that. US overseas funds. We'll put overseas. Look at the overseas funds. Google will just put that. Overseas mutual funds. So international. Okay. Now Franklin, say let us say you got Franklin India feeder, this one US Opportunities Fund. Okay, so let's look at this particular scheme, how it has done well. So the scheme, so plan option, so direct growth, we are not getting the return like easily. It's 8 years or so, and let's look at the So 3-year performance, the highest return that it got was around 35.27% per annum, and the average is around 13.5%. So that's one of the good thing that we are getting here. And the lowest has been only minus 3.14%. So that's a very good this one. So there the investment is mainly in the equity, which is 99.75%. So about the scheme, you can look at the this one, investment objective, performance ratios, and other things, and then you can just choose whether how the performance of this. But if you look at the performance, it has done very well. 3 to 5 years period, if you look at it also. The average return, lowest return that it gave was 3.02% per annum, and the highest return was 29.81% per annum. So average is 13.86% per annum. So this is one another great fund as far as the return is concerned. So you can do even a systematic investment plan in this scheme, in this particular thing. So here, if you just again, if you invested 6 lakhs, what is the profit that you have got over a period of say 5 years or so? Is what is the return that you have got about this? So annualized return that you are getting here is around it's very good. If you get around 27.06% is the average is the return that you are getting here. So compared to normal bank return, which is 7.8, and category average category is on 18.33%. So compared to even the category performance, Franklin India Feeder Franklin US Opportunities Funds has also done extremely well. So monthly SIP of 10,000 rupees over a period of 5 years has returned like this. And if you do for 3 years, let us say, then also the return is something like this. Fund has given a return of 32.49%. 32.49%, and with the category average is only 24.17%. So the SIP here seems to be doing much better than the SIP of our funds. So let us say 3 years and 5 years return that just now we saw. Both are the 3 years and 5 years SIP schemes have done much better than our own ETF. So Franklin India Feeder Franklin Mutual Opportunities Fund is another good area of investment for a systematic investment plan. So please consider that also, where you can make an investment on any particular date. Okay. So now we'll look at the other schemes which are available here. Nippon India US Opportunities Fund, Franklin Asia. So you can look at global emerging markets which have done well. US Prudential is what we have seen right now. So these are all the various funds which are available in for investment worldwide. And Japan Fund is there. So Sundaram Global Brand Fund is there. So your Edelweiss US Opportunities, so Investco. So there are so many other important funds which are there. And you can look at any of these funds for your own this one. So the Franklin India Feeder Fund, which is US Opportunity Fund, has done well compared to European Growth Fund. So I think probably you can look at the investment mainly in that particular sector. Kotak Nasdaq under FOF. And right now we don't have much of a detail as far as Kotak Nasdaq, but we have got a Motilal Oswal Nasdaq fund is there. Let's look at whether so what is the return this has given? Over a period of 1 year it has given this. So let's look at the 3 years and 5 years return. So this scheme is only there for the last 1 year or so. So we are not able to make big comparison as far as the scheme is concerned. But if there is one thing which is called a Motilal Oswal N100 in the ETF, and this is nothing but the Nasdaq thing. So you know if you look at that fund also has given a very good return, ETF fund. So if you do a systematic investment plan in N100 funds also, which is there in the NSE platform, then that return is also very good. So if you want to invest in Nasdaq 100, you can, for an ETF, you choose Motilal Oswal N100. That is good. If you want to invest in overseas fund, probably which can slightly beat our index over a period of time, is Franklin India Feeder Fund, which has done well. So these two overseas funds you can consider. In India, you can choose for IT means you can go to ICICI Tech. You can choose. If it is ETF, you can choose anything. Gold, Nifty Bs you can choose, and also you can look at in India, if you're a mutual fund, you can look at Axis Blue Chip Fund as well as Axis Midcap Fund. all these things you do SIP, your return will be very good. So even a fall like this, which is happening right now, you can do either two things. One is you can wait for a particular calendar date for investment. When I say calendar date is that, let us say last month, it was 13,600. You might have invested at 13,600 last month. So this month, maybe you're looking at the end of this month, whatever value that you get by the end of this week, you make an investment. So do some sort of an investment of 5,000, 10,000 and see. And see what is the return that you will get for that particular scheme over a period of time. Now, this is as far as the returns concerned, as far as the equity schemes are concerned. We have still got one more scheme that is left, is the gold. So we will keep it for one more day because time is already 7:50, and so we will keep gold ETF review for another week. Okay, and then summarize of how whether between then gilt fund also we look at it. So we'll just look at all these things summary with the gold this one special emphasis on that next week. So you can ask your questions now. Thank you very much. So I'll take leave of you today. So probably on Friday we'll review the performances of this particular thing. We'll review the performance of Nifty index, Bank Nifty, as well as other stocks for this month, and look at what probably can happen next month also. Thank you very much for the participation. Hope this session was useful. Thank you very much. Bye.